Hello, everyone, and welcome to Cota Access. My name is Holly Rowland. I'm an operating partner for Cota Capital and the host of Cota Access. We're going to talk about the open banking paradigm and how it will change banking as we know it today. First, a bit of background and a legal disclaimer. This session is part of Cota Access, a webinar that we host several times a year. Cota Access brings together founders, thought leaders, and leading executives to explore a variety of business and technology trends and topics that fundamentally impact our society. While the operating partner and the guests on this webinar may have affiliations with Cota Capital, the views here expressed are those of myself and the guests alone. We strive for accuracy, but cannot guarantee the accuracy of the information in this session now or in the future. Cota Capital is an SEC-registered multi-stage investment firm based in San Francisco, focused on US-based modern enterprise technology companies. Cota has invested in over 75 private and 25 public technology companies since its inception in 2015 in the fields of infrastructure, workflow automation and applications, fintech, and health tech. Now, back to our topic. How the open banking paradigm will change banking as we know it. Our moderator today is Ben Malka. Take it away, Ben.
Thank you, Holly. I'd like to take a moment to thank everyone at Cota who's involved with producing Cota Access events. Christina, Allison, and Holly do an amazing job keeping all of us organized and focused on delivering great events. Simone, of course, has set a high bar on content, and we only hope to match his efforts. I also wanted to let the audience know that in addition to serving as an operating partner with Cota, Holly advises several of our portfolio companies as an interim CMO. For those of you who are new to the Cota community, I encourage you to reach out to anyone you see who is part of Cota and me individually if you prefer, and happy to connect you to the right folks based on your interest areas. As for me, I'm a partner with Cota and focus on the fintech sector and some of Cota's fintech portfolio companies. And today we're going to be talking about open banking, which I think is one of the most important paradigm shifts in banking that have happened since I started investing in 1999. It's going to lead to new regulations, new approaches to consumers, and perhaps even a change in the competitive dynamics in the banking sector. We've got a great panel to talk about the changes coming from open banking. And I wanted to introduce them and then let them provide a bit about their background. First, we have Jason Henrichs, who's the CEO of Relied Labs and runs a consortium of innovation with mid-market banks in Minneapolis and Chicago. Bill Elderton is the CTO at Roostify. Aaron Iovine is the head of policy and regulatory affairs at Cross River Bank. Trey Maust is the co-founder and executive chairman of Lewis and Clark Bank. It's a great panel, and we're lucky to have them here this morning. So just to get started, I thought we'd have each of the individual panelists tell us about their backgrounds, their perspectives on open banking, and the approach for your solutions.
Thanks for that, Ben. Jason Henrichs, CEO of Alloy Labs. We're a consortium of community and mid-sized banks that work together to drive innovation, adopt new technology, and to make strategic investments. We're just over 50 banks by combined assets. We actually are a top 25 bank, and we tend to focus not just on how do you re-plumb the bank or think of as digital transformation, but actually how do we go about reinventing banking, and open banking is a big part of that.
Trey.
Good morning. Well, over the past 26 years, I've had my hands in a variety of domains that have either been in or around banking, everything from capital markets to M&A to bank CFO to bank founder to industry policy and advocacy leadership to CEO of a bank, and also one of the least known, but probably one of the most impactful financial sector initiatives that now covers over 70% of all the nation's deposit accounts and retail brokerage assets. So a lot of different areas. But the past 10 years, I've been particularly concerned, then focused, and I think now I'd say it's shifted to anticipatory about the roles that both incumbent banks and financial technology firms can play in the future of banking and more broadly financial services. And I'd be happy to talk about kind of my perspectives on open banking. We can do that later or now, Ben.
Let's go through the intros first, and then we'll get to that.
Great.
So, Aaron, perhaps you can tell us a bit about your background and what you bring.
Absolutely. Thanks so much for having me. It's really a pleasure to be here. My name is Aaron Iovine. I'm the head of policy and regulatory affairs at Cross River. Prior, I had spent time at White & Case in their financial institution advisory practice. I'm a lawyer by trade, but please don't hold that against me. And then also have spent some time at the country's largest trade associations in the financial services space, the Clearinghouse before they were BPI, and SIFMA as well. So really have, through my career, spent time looking at both legacy financial institutions, fintech, and really the digital transformation undergoing the industry today and in the future.
Great. And Bill, perhaps you can walk through your background as well.
Yeah, absolutely. Thanks, Ben. Thanks everyone for joining. Bill Elderton, most recently CTO of Roostify for the last couple of months. And at Roostify, we focus on digitizing the mortgage process, making it easier both for the borrower and the lender to have the most seamless experience possible for getting a home mortgage. Prior to that, I was at a company called Q2, where I focused on online banking provider from a technology perspective, as well as running the Q2 Open or Q2 Banking as a Service group for the past couple of years, bringing together fintech companies with banking, which really exemplified the open banking initiative on allowing the fintechs to come and offer bank-like services.
Great, thanks, guys. So I wanted to direct the first question to Aaron and Trey and ask you the question, why is open banking such an important topic and why now?
Yeah, I think open banking is really tied to digital transformation and a lot of issues and really exciting innovations that are popping up within the space. And so whether you're building new technological solutions, whether you're partnering with third-party service providers, the innovation, collaboration that's lowering costs, that's bringing financial services into the modern age is extremely important. And I think within the new solution also comes expanded access to the financial services system, especially for those who have been traditionally underserved or locked out, have not had access to legacy institutions or legacy products. And open banking is really providing opportunity to expand that access and bring people into the financial fold.
Yeah, I'd echo Aaron's comments, and thinking back to GDPR, to PSD2, to open banking legislation that was enacted in UK, EU, and adopted by other countries outside of that Eurozone. That I think that legislative prescriptive approach to open banking in those jurisdictions, while it was enacted to encourage innovation for the benefit of consumers, I think it also, what's interesting is it did stifle innovation initially. There was some reluctance to take that on by especially some of the larger firms, whether it was just because they're large and complex or because there was some reluctance to develop the standardized APIs. But being forced into that environment isn't a great incentive to encourage proactive input and engagement from incumbent banks to foster innovation, whether that innovation is in-house or through third parties. But I think it did open up the conversation about we either need to develop it from a market incentive standpoint, or it's going to be forced upon institutions to provide it. Or later on, I did want to make a comment about if the market doesn't force it, or if legislative bodies don't, then it's quite possible somebody's going to try to work around the existing prudential infrastructure that exists today as the underpinnings of the banking system. I think here in the US, we have an opportunity to take the lessons learned around prescriptive open banking requirements and create a market incentive for incumbent banks and fintechs to work together. And this is already happening. It's obvious it's already happening organically. I mean, the marketplace has, I think, an ever increasing appetite for new, different, and more convenient ways to consume financial services. And I know we'll talk about this a little bit more later when we're thinking about the future of banking. So I'll stop there, but I think we're poised at an inflection point for this to really accelerate. I think it's really a question of whether more banks than just the 40 today that are providing some element of banking as a service or banking infrastructure as a service will jump on board and provide that access to the underpinnings of banking.
Trey, you brought up a subtle point, but I think it's one worth making. There is open banking with a capital O and a capital B, which is PSD2 and GDPR enacted in the EU. And you'll hear from a lot of banks and incumbents in the US in particular, where we say, oh, that will never happen here. But lowercase o and lowercase b open banking is already here through banking as a service, as you described. The fact that banks of all sizes are beginning to open up APIs, Cross River being a great example of that and what it enables. And so for those who'd say, oh, from a legislative or a regulatory view, won't happen here, won't happen in my geography. The fact of the matter is, it has happened on both sides of the ocean, right? Asia is one of the leaders of the non-financial institutions like Ant Group and others that are really, opening up technology and flow of information because it's better serving customers. So it is already here, and it is coming as two giant waves from both directions to hit the US.
Yeah, so now we're starting to get to the part of the conversation which I think people can relate to if they're not deep in the banking sector. What really should consumers be expecting to see in the next, say 5 years from open banking changes? And maybe someone can take on what exactly do we mean by open banking? How did it actually get started, and why is it so important?
So I'm happy to take that on, I guess, since I opened the can of worms, and it really does become a can of worms for a lot of providers. Traditionally, most banks, even the largest of banks, bought their technology from incumbents. And what started as, what is known as the core banking solution, the general ledger, that was, kind of the sacred ledger of settlement in terms of what is where interest accrued, payments going in, out, and so forth, expanded as the types of services and the way we delivered services changed within banking. As we moved from a human interface between the technology to technology actually going direct to customer. On first the ATM being the place that you interacted, then online banking or internet banking as it was first known, then to mobile banking. And now we're even getting into the world of banking isn't even happening within your banking application. It's happening lots of different places, or it might be through a third party that is partnering with a bank. Well, what's happened is in that, very tightly integrated tech stack, data only flowed well vertically within the tech stack of that provider. And what we're moving to now was, first a world where it looked a lot more like a layer cake that we integrated across different types of applications, to a world that's going to look a lot more like a series of Legos in terms of where information flows. And so open banking is really about this idea that the transactional information, the types of services you get, and how your information is distributed is actually being driven and opened up, thus the name open banking, to a variety of players instead of just being confined within that vertical integration.
Yeah, and I think Jason hit some really important points there. And I think one of them is the diversity of offerings, and consumers can expect to see more seamless, frictionless, and just better experiences from their financial services products, how they choose to engage with the industry as a whole. I think it's really important. And, Jason also mentioned, I think the history has traditionally been that legacy institutions with the resources have just been able to buy the technological capabilities that might give them a competitive advantage. And as we move and continue to move to a more digital world, now you're seeing smaller institutions learning how to innovate to survive, to whether it's partner, to collaborate, to acquire, or to build on their own. There's a variety that are giving smaller banks opportunity to step up and punch above their weight. And happy, to be at Cross River, a place that is demonstrating that, and through our partnerships in a number of different spaces, and really about how to embrace responsible innovation. And from a regulatory standpoint, I think, right, the industry is really at an inflection point, and it's the question of, will the industry be shaping regulations from pushing through, or will the agencies be proactive, and will the regulations be shaping the industry as a whole? And so I think it's no matter how you slice it, it's important for companies to be engaging with the regulators, to be transparent, for people to be having conversations like this, so that tangible policy decisions can be made for, a practical solution moving forward as banks continue to look to implement these solutions.
And I think that the technology that Jason touched on is really, from my perspective, one of the key enablers over the last several years. So if you think about the core processors, the ledger, if you will, as Jason mentioned, a lot of that technology hasn't been touched in the last 20 years. And typically the banks are used to a batch style processing where once a day things clear. And what this open banking has allowed for is other technology providers to step in as a subledger or as an online core provider or a cloud core provider that offers the fintech companies an API to do real-time transactions and real-time updates, which has really revolutionized the ability for the fintechs to take off and provide that experience that the more sophisticated customers in the world now are expecting. So the advent of the iPhone 10, 11 years ago completely modified the consumer's expectation of how they're going to interact with the rest of the world around them. And the technology from a provider perspective is now catching up to an API-based technology where I can have real-time access into debit card transactions. And if you think about things that are capable today that weren't even thought of even 5 years ago, when I swipe my debit card, to be able to pin that on a Google map somewhere to show me exactly where my debit card and the last 10 transactions I made were actually physically made and where I was standing when that happened. You think about the impact of how fraud analytics and the consumer's understanding of how and where they're spending their money opens up an entirely new opportunity beyond things like personal finance management, which were all the rage 10 years ago. It opens up a whole new area of technology that I think is just now starting to get tapped into. And from my perspective, 5 years ago, a lot of the smaller to mid-sized banks were feeling like these fintech companies were competitive to them and we're going to put them out of market. And now what I think we're seeing is the opportunity for these small regional credit unions and banks to actually bank the fintech and become part of the solution has opened up an entirely new revenue stream. Is my view from Q2 when I was there was we're allowing small, mid-sized, small market chartered institutions to reach people well outside of their geographic area and get customers across the entire US instead of just their county in Texas or their county in Iowa. And so it's been an amazing transformation. I don't think it's going to be the end of banking as we know it by any stretch of the imagination. It's going to be an acceleration of the consumer's expectation of technology, and the way they interact with the pizza delivery becomes as simple as the way they interact with their financial institution going forward.
So Bill, you brought up a really interesting point there about the map and the consumer. Privacy and open banking in conflict, and does this tension ever get resolved?
So I think that's a phenomenally great question, and I think it always has to be at the forefront. And I think to Aaron's point, this is exactly why we can't allow the fintech, the regulatory bodies can't allow the fintechs to go on this alone. They have to be partnered with a financial institution that is first and foremost concerned about the consumer advocacy and the consumer privacy. The fintechs by nature aren't going to worry about that. They're worried about the technology itself and what they can offer and how fast they can offer it. And so that balance of fintechs working with banks or chartered financial institutions, whether it be a bank or a credit union, in my opinion, has to be the path forward if we're going to keep advancing the privacy and protection acts that the consumers want. And it doesn't become a runaway system. I think Aaron made that point, and I can't agree with him more on the direction of that.
Yeah, and just to build off of that a little bit, I think, especially in the earlier days of partnerships, what a lot of fintech looked to banks for were their regulatory oversight, their compliance, their ability to really use their core competencies. And banks were relying on technology firms for the innovation part. And Cross River was founded in 2008, and so we're a community bank based in Jersey. We have one branch, don't have an extensive branch network, and so really at first relied on those technology partners. But I think part of the success also moving forward is that financial institutions also have to grow with their partners. You have to be able to provide not only a regulatory backing, but a cultural fit, a technology fit, to have longevity in these partnerships and relationships. And I think, as we talk about privacy, it's a great question that leads to a lot more important questions, because I think some of these are at the forefront and haven't necessarily been settled yet in comparison to international counterparts. And so in the US, I think there's still an open question of how consumers view access and control of their data, ownership, the rights of it, the sharing of it. And I don't think that's fully settled. I think that's something from an evolving standpoint that we're going to continue to see as we set the rules of the road. And to that point, you see the states right now acting independently with privacy and data legislation. And so, that it's great to see proactivity, but the potential concern there is, are we going to deal with a fractured framework across 50 states? How are we going to make it manageable and practical so that we're not stifling innovation, that we're fostering it? Is there going to be a federal solution in uniformity? I think these are all great questions that are going to help shape the future.
And while the patchwork, Aaron, can pose a challenge, I think it also poses a lot of opportunity. One, in that states historically have been more willing to be proactive than the prudential regulators have in creating zones of opportunity, whether that be in the form of a sandbox and allowing people to operate there. Sandboxes at a national level in both the UK and in parts of Asia, in Singapore and Hong Kong, have actually been tremendously powerful in promoting responsible innovation, such as you were espousing earlier, that it's very hard to do things at a national scale and get it right in a very fast fashion. We tend to take that, what I like to call a monumental approach. Monuments are typically built to something really bad that happened. We take a whole lot of time to build them. And unfortunately, they don't get revisited all that often and rarely are torn down, right? And what we need is actually something much more iterative.
Yeah, I think those are great points. That's spot on.
And just one more. I think Jason and Aaron, you guys are spot on with this. The concern from a technology perspective has always been, if it's too regulated, if it's too tight, then we see exactly what happened in this space where the fintechs launched themselves because the banks weren't able to keep up with the consumer demand of technology expectation. And so this go round, we have to be in the middle of making sure that balance occurs so that we don't have a rogue opportunity to go off and do something crazy. And I think, California was probably one of the first states to really implement GDPR. And the way that's changed the privacy and the data protection for the typical consumer. And I think that the industry itself is starting to embrace that from a regulatory perspective. I agree with Aaron, and it sounds a little strange coming from a technology guy, having that base at the federal level so that we don't have to worry about California does it different than Utah, than different than Texas, than different than Iowa is absolutely what's going to allow this to propel beyond just the regional borders of state to state. It's an absolute necessity to get where I think this is naturally going.
And let me just jump in and turn the topic. So one of the things that we all think about as investors is, how is the world moving? Who's likely to benefit or fall to the side based on the changes? So maybe I'll direct it at Trey, who's a CEO of a bank, and tell us a bit about what you see as the benefits and drawbacks for the different players involved, both banks and fintechs and consumers.
Sure. And I did want to circle back to the what does the world look like 5, 10, or 15 years from now? And I think just to anchor us, because we have touched on quite a few of the raw materials that can power some pretty impressive innovation over time. I think transformational. And so maybe later we can touch on that. But just to answer your question on the various parties that will play an important part, I think first and foremost, for a well-functioning economy to persist, consumers have to have, they must have absolute trust and confidence that the underpinnings of the storage of their money, the movement of their money, that is safe and sound. And this is really the key role that incumbent banks, currently do, and I think they should continue to play, especially given the strong prudential and consumer protection umbrella that already exists. But at the same time, banks have been forced into vertically integrated supply chain for quite some time, and Jason touched on that. And I think at times that can stifle innovation, reduces consumer choice at the engagement layer. And I want to talk a bit about the engagement layer, because I think that's really the key role that financial technology and other innovators can play. And that's what changes the experiences that consumers and the public have in engaging with financial services. I think, nearly all other private sector industries have a retail engagement layer that provides that broad array of that sort of ever evolving experience, functionality and conveniences for consumers. Now, on the other hand, while banks may not be able to deliver that in a vertically integrated fashion, I would never advocate for that same vertical supply chain to be owned by, so whether that's payment rails, Fed master account, federal government backstop, and so on. I don't think financial technology firms should own that either. You just can't hand the underpinnings of money protection and money movement over to a culture that necessarily has to think about innovation, think about breaking or building, breaking, failing, learning in order to really foster innovation. But the two cultures, while they have considerably different risk tolerances, like oil and water, you can get the best of both worlds, I think, in this case, for the benefit of consumers and the broader economy by coexisting. And I think now's the time where we've got, like we talked earlier, we've got all these elements of the raw materials. Can we leverage each other's strengths to support an integrated supply chain that serves the public more effectively? And I think we can, again, look to other verticals to identify how that can work. And I think that's the future. Banks have recognized this and begin to provide that banking infrastructure as a service. And fintechs will see the opening up of more and more banks that provide these services to enable fintech founders to focus on customer acquisition, customer engagement, new ways of doing things, dreaming up the next evolution in banking and financial services. I think that's the winning combination in that case. And just to anchor it to what could that look like 5, 10, 15 years from now? If you can indulge me, I want to just paint a picture, because I think this is it's interesting. And I think as you think about the allocation of capital to fintechs and to others that are supporting how things could look 5, 10, or 15 years from now, having an anchor point is important. And I think we normally envision innovation, whether it's incremental or transformational, in the context of how we interact with the world today. And I think was it Aaron and Bill talking about the fact that we didn't have these 15 years ago. The smartphones didn't exist. The first iPhone was, I know we had Blackberries, but the first iPhone was introduced in 2007. Financial services firms were delivering services electronically, sure, but very different and in a highly controlled manner. Banking services were almost exclusively accessed directly through banks in that vertically integrated supply chain. I think one of my favorite quotes about the pace of change, and I won't say who I'm attributing this to because he's going through, he's being raked through the coals right now in his personal life, but we always overestimate the change that will occur in the next 2 years. And I think that's true. I mean, we expect a lot of change in 2 years, but it tends to be incremental. And then we underestimate the change that will occur in the next 10. And I think this is especially true when making forecasts now about technology platforms that consumers will engage with. And we keep thinking about this as that medium. And I don't think that's going to be the case. I mean, today, consumers definitely live on their smartphones, their connected devices. They access banking services, whether it's that safe storage, the borrowing of funds and moving of funds from point A to point B, paying for things through media like that. And these are of course delivered, whether it's bank-owned apps or third-party apps. It's the medium that's used today. And what's interesting though is that a monumental change is occurring. And this was at a prior Cota Capital webinar, and actually the slide shocked me. I had not recognized or realized the impact that non-banks had on the opening of accounts in the United States. If you were to look at this more than 3 years ago, almost no accounts were opened at non-banks, so banking accounts. And I saw that slide. A recent survey, wasn't Cota's survey, but asked if consumers nationally would be or already are interested in banking with a non-traditional financial institution, and nearly 2/3 said yes. And then I'll move over to the slide that Cota Capital had presented, and that is that 3 years ago, 3% of all new consumer bank accounts were open at challenger banks like Chime, Moneyline, Acorns. That number is now close to 20%. 20% of all of the nation's bank accounts opened by consumers at non-banks. And to me, if that's not a sign of disruption, I don't know what is. So what does tomorrow look like? 2 years from now, I think it's incremental. 5, 10, 15 years, thinking beyond smartphones, I think the future of banking is two things. It's financial microservices that are seamlessly embedded in infinite ways into the consumer brand experience and into all areas of consumers' lives. And I think about a credit card. So pulling out the credit card, why do I need to do that? Why do I need to pull out a smartphone, a watch, or anything that is physical, or that I have to stop what I'm doing with a brand like Starbucks, my grocery store, restaurant, microbrew, or even an online merchant? It's a disruptive experience to have to pause, make that payment, and then resume the interaction. So I think element one or component one is the future of financial services. I think is going to embrace a seamless and embedded microservices to power transactions, all working behind the scenes. And I don't think that's a new concept. My second prediction is, I think, an interesting one, and that is the concept of pooled financial resources. So both in the form of deposits on account and I think overall credit capacity. So I'd analogize that to corporate treasury or FP&A functions within an existing company, but actually for individuals. So for consumers, I don't see a reason why we can't at some point manage this smartly, automatically, and behind the scenes. Think about consumers having to think about manually managing, transferring money among a host of accounts, especially as those number of accounts grows among banks and non-banks, and then deciding kind of which to draw from for a particular good and service, separately having to determine where to borrow funds for a larger purchase, whether it's groceries, a car, tuition, or a house. I think eventually this is all automated, not through simple account aggregation or PFM software, but this is where the investments in open banking, like we're talking about today, edge computing, IoT, and RPA in particular will play I think, their parts in powering that future. So I think that's the future of banking. I'm not sure that incumbent banks can deliver that on their own. I also don't think fintechs can deliver it on their own either. And again, it circles back to the concept of, if we can power the prudential underpinnings of banking and finance by existing incumbents, and then what we're powering then is that engagement layer and the innovation layer that fintechs can play.
Anyone else want to take a crack at how the world's going to be different?
Yeah, I think there are some really incredible points that Trey hit there. I think what I want to focus on is the evolving, what is going to look to be the evolving nature of collaboration between fintechs and the banks, and who is providing what service and what role each plays. And you've already kind of seen, I think, the first stage of that evolution, where incumbents or legacy institutions viewed fintechs as threats, and now you're seeing them view them as partners, as opposed to necessarily threats or competition. I think you've seen fintech understand where their strength lies and what they rely on financial institutions for. And as we continue to look at things like how are consumers opening up accounts, where are they opening up accounts, it's also important to understand the relationship between the bank and the partners, right? So recently, California, making it clear that Chime is going to have to, not say Chime Bank, right? And that there is an underlying bank, and consumers, as embedded finance and microfinance becomes more and more integrated, consumers wanting to be sure about, where they're putting their money. If they're opening a CD or deposit that's, hosted in coordination with a third-party fintech, is that money insured by the FDIC? Who is the bank holding the account? It's, while the relationship primarily or from the front side might look like it's through the fintech, it's really happening through the back end bank as well, providing that relationship and the surety that we touched on a little earlier, to ensure that the integrity of the financial system is kept intact, that the products being offered are consistent with principles of safety and soundness. And I think all of those things are set to evolve, but you're going to see, I think, the one thing that will remain consistent is the role of banks in providing that security, as much as these relationships continue to grow and evolve. and what banks are able to offer.
So Jason, I was going to direct the next question at you. Given that you have a fair amount of contact with the regulatory agencies that serve this community, what would you like to see happen as open banking evolves? What pieces need to take place for we all to end up in a better place?
It's a great question. And, I think the chairman of the FDIC is doing a phenomenal job in this regard in terms of beginning to drive change instead of waiting for change to drive it. And this idea of opening up a formal office of innovation, being more proactive in their engagement with the banks, because one of the challenges for the smaller banks is if they go do something that is aggressive and new, either in a partnership or developing it on their own to try it, something that could actually be transcendent rather than incremental and change, it doesn't work out and they get slapped with a $7 million fine, Jamie Dimon's going to be just fine, right? That is the cost of doing business and driving innovation. And if that happens to a smaller bank, however, that's catastrophic in many regards, and they can end up being put in a penalty box for too long. So we need to create safer spaces to innovate. And I think a big part of that is the encouragement that the chairman has been doing when she pushes that banks of all sizes need to look at partnerships, but they need to actually think of them more carefully as true partners, not vendor relationships. I think, one of the challenges that you see when the fintech wants to move faster than the bank, and they can bully the bank to a little degree now because there's more banks trying to get into the business. And I'll be honest, right? In 2008, I co-founded the first, formal challenger bank on using a debit card in the modern banking as a service infrastructure. And I can tell you, we were pushing their compliance department probably faster than we should have, but it was all new. And so I think all three parties, both the regulated entity, the regulator, and the fintech, need to come together to actually drive responsible innovation.
I think one of the things to your point, Jason, is if we don't take this responsible approach and tying together the financial institution and the regulatory body with the fintech, I think we'll start to see more of what we're seeing a little bit today in the world, which is fintechs going out and acquiring a charter of their own, and either through the certification of the registration process, which I know doesn't happen often, but you look at somebody like Square, who just received an ILC charter, one of the first in 10 years, or what I think will happen more likely is as some of these fintechs become, very well financially backed and very large, going out and purchasing banks of their own to serve at their bidding, in which case then they can push that compliance department as hard as they want, at least for the first year or so until they get busted, right? And so to me, keeping that regulatory presence as part of this responsible growth is a huge part of how we continue to grow without having massive problem sets of the $7 million fines that completely eliminate a smaller industry or a smaller bank or a smaller fintech company that can't afford to take on that type of innovative costs. That's if we don't want to suffer fits and starts, then bringing those three teams together from the beginning, I think, is the only reasonable option.
I think that's spot on. And so there are a few things. I think one, we're talking about a lot about the actual cost of a potential enforcement action. But I don't want to overlook the cost of reputational risk, especially for smaller institutions that might not have national name recognition or be household names, but are really working hard to develop responsible innovation and offer these products. And if the rules of the road aren't clear and you're slapped with an enforcement action and you have to deal with the reputational risk, you're creating that much more of a competitive disadvantage if you're a regional or community bank with a smaller name. So that's certainly another reason. And we touched on the great efforts at the FDIC and their innovation office. And I think I'm really optimistic because you see this across the industry from the prudential regulators, and you see them being proactive in releasing requests for information on various technological capabilities. You see them engaging They're hosting office hours and the ability to, they're opening their doors for industry to come in so that they can better understand what's going on. And for that point, from the industry's perspective, your regulators should know who you are. They should know what what you're doing, how, especially if it's innovative, if it's a little new. They should, you should go out there to help them understand the functionality of these products, and you shouldn't be afraid of that level of transparency, because ultimately that's going to create the trust and the comfort level that's going to allow the agency to push this innovation forward, to understand how to craft the rules of the road. And really, instead of acting as a barrier, they're going to act as a partner. So I think it's extremely important. I think the level of expertise you're seeing go into the agencies and the talent internally there, of, I think it's at a new height of levels we haven't really seen before, of the amount of expertise and people who really do understand what the industry is doing and how to, practically allow that and balance consumer protection and show that you don't have to sacrifice one for the other, that you are actually working hand in hand to offer more seamless experiences. And so I'm really optimistic about the agencies and the future from the regulatory standpoint, given, I think, what we're seeing at that level right now.
Because if we don't see the frameworks and the approach change from the regulators in the US, we're going to end up, stifling innovation, which will not be stopped. It will just be driven into, the back alleys of innovation where the bad things will happen, right? And that's bad for the industry writ large, because when really bad things happen, really stern measures tend to be enforced. And I think the FCA, the regulator in the UK, did a phenomenal job in this idea of taking an approach that regulation is not about, dotting the I's and crossing the T's, but let's actually pull back to fundamentals. And one of the first fundamentals that they said when you look at innovation is, what's in it for the customer? It can't just be an innovation that is good for the bank. The second thing they, look for is, how do you monitor for what could go wrong? And then what is your plan to actually make, that customer whole? And if you do those things, like those being the rules of the road for responsible innovation, might you find yourself in trouble? Yes. But when you can show your intent was good, that it was principles-based regulation in an approach, as opposed to, the legalistic approach to regulation, it's a lot easier to say, even if I don't have exact clarity on what the rules of the road are, I know the intent, and that can be measured.
Jason, that's a really fundamentally important point. Principles versus rules-based when it comes to consumer protection. It would, well, we talked about the FDIC's initiatives around innovation, the OCC as well. The Federal Reserve certainly supports it, but OCC and FDIC have been pretty leaning forward on innovation strategies and initiatives. That's been helpful. That consumer protection umbrella, and I think to some extent shadow that kind of sits over the industry, causes most of us to be reticent to take on any risk, because the hammer is so hard when it comes down. I think it's interesting to use it as a comparison, because the FCA, which is fundamentally involved in GDPR and open banking and others in the UK, is a good model to consider for us moving forward, to really provide that adaptability for us to provide supply to fintechs and others who want to innovate.
Great, thanks, guys. So I'm going to tee up two questions, and I'll give you guys a chance to pick which one. You talked about the dark alleys and also different geographies. So maybe you can try to address the questions around, what do you say to the people who want to tear down the existing system and are focused on crypto and blockchain as the primary source of differentiation and value creation? Or what geos have moved quickly, and what are the results in terms of competition and product changes?
Well, I think it's a great question on the geo. From my perspective, what I've seen is the two coasts, the West and the East Coast, from a technology provider perspective, have really moved quickly. A lot of the fintechs that are household names or name brands are coming from either the Bay Area or Southern California or upstate New York or Manhattan themselves. But the banks that are, banking these fintech are in the flyover states and are the Midwest and the central, north central regions of those communities. And I think part of the reason is the sheer number of people that they can reach increases dramatically when they partner with an Acorns or a Moneyline, as Trey mentioned before, completely stretches the boundaries of where they can have their outreach. And if you go back to a mission that I think a lot of the community and small banks are trying to achieve, which is to strengthen their overall community, giving them an opportunity to reach outside of their geographic region in order to serve people in California, New York, New Jersey, Florida, Texas, those larger economy states, gives them an opportunity to bring some of that money home and strengthen Iowa, strengthen Nebraska, strengthen Wyoming, which is where we're seeing a lot of these smaller regional banks are actually banking these fintechs come from. There's not a lot of institutions in Dallas and Houston that are doing banking as a service, right? It's a lot more of the Midwest and the flyover states that are doing this. And I personally believe it's because of the opportunity for them to reach beyond their normal borders and serve a larger community than they've ever been able to serve before.
I would definitely agree with that. And just to build off of it a little, I think in a lot of those states, you're also seeing the importance of the cooperation that we've been talking about between the regulatory agencies and those institutions. And you've had more aggressive agencies wanting to open their door, wanting to innovate, wanting to be a hub for some of this technology and be a first entrant kind of staple and provide the ability of a national framework that's been traditionally reserved for some of the larger state regulators. I think you see exactly in those geographic regions that you were just talking about, those regulators not being afraid to speak up anymore. And I think that's a really productive mentality in terms of working with the industry and in terms of offering new products and again, reaching consumers that haven't been able to be reached before. I think as we continue to see a digital world where, people live X amount of distance from a brick and mortar branch and don't have a lot of option to services that they really need to help take control of their financial health or build wealth, you're going to see these options play a fairly large role in those geographic areas.
Yeah, it's funny. So for whatever reason at Alloy Labs, we own Iowa. Don't ask me why, but we have a lot of banks in Iowa. But we're spread out of the 50 banks. They're all over. But one of the interesting things is a quarter of the banks that do banking as a service are Alloy Labs members. And what's been interesting to watch, this group has actually come together in the absence of having a clear roadmap of what the future looks like. We started collaborating on our own to develop standards around this and to say, how do we develop a best practice in this kind of partnership proactively? And I think this idea of collaboration across the industry as opposed to everyone's the competition is ultimately going to be good for the customers, both consumers and for business. Where we've been spending more of our time isn't just the partnering with the banking as a service startups, but what I like to call the edge of money. As banks, we're used to being in the center of money, or for the fintechs being in the center of money, where you store your money or you invest your money or where you get the loan for your money or you conduct the transaction. But we forget for the customer, that is part of a broader story of what they're trying to accomplish. Rarely does someone wake up and say, I think I want a new mortgage today. Unless you're like a rate watcher, it's part of I'm moving or I'm having kids or my kids are leaving or I'm relocating, right? That's the story arc of why you're getting a mortgage, what it fits into. And if you were to say, what do I think financial services looks like, 10 years from now, well, using Trey and the anchor points, I think 5 years from now, what we see it looks like is, the bank and fintech working together with fintech being in the lead. But I'm going to go so far as to say 10 years from now, fintech itself is displaced. While it is common, and Andreessen Horowitz wrote this great piece, my friend Angela, that fintech is everything. I'm going to say 10 years from now, fintech is nothing because it's embedded. We're not going to think about it as fintech in the traditional sense. As Trey was saying, it's part of a brand, it's part of a purchase, it's part of some other behavior that I'm doing because it's the means, not the end.
Jason, I think that's a phenomenally great point. I think we saw the same thing with so-called digital banking or online banking, where it was if I want to do online banking, I have a few options to go to the proliferation of the technology across all sized institutions, where now it's just it's a commodity almost. And I don't mean that in a negative way. I just mean that the access for all consumers to have a digital alternative to how they bank today has occurred. And that's occurred over the last 7 to 8 years, maybe 10 on the stretch. And I agree with you on the fintech side. Instead of banks banking fintech, they're just offering those financial services in a more modern and consumer-friendly way that aligns better with the technology of the day. So, yesterday it was my iPhone. To Trey's point, tomorrow it's my watch. And then after that, it's just embedded in a chip in my whatever, and it just becomes part of my life. And it's not something I have to go out and look for. It's available to me no matter where I turn. And I think you're absolutely right. And we've already seen this trend happen over the last 7 to 10 years. Why would it not repeat itself? Because it was so successful the first time.
Yep. Just as a reminder, if anybody wants to submit questions, you can use the Q&A function in Zoom. We'll be reading them and addressing them at the end. And so no one took on the crypto question. Anybody want to go after that?
So, yeah, Ben, actually,
Trey by default.
It's interesting. I don't know. It's all, I was just thinking, Jason, you articulated what I was thinking in terms of like the pieces that just the microservices embedded, and kind of the broader narrative, I think, is consumers are thinking about what they're trying to achieve, not the money movement or the storage of money as the end, but the means to an end. And so, so I'm wondering, is cryptocurrency one of those? Is it a stopping point on a longer journey that we're on, and it isn't the end, but it's just another piece of it, or it prompts something else to happen. So it was interesting. There was an article in the Wall Street Journal today on cryptocurrencies, and I didn't realize the estimated amount of legitimate transactions that are actually transacted using that form of or medium of exchange. And it's about 2.8 billion estimated last year. So not a large amount, but it certainly has an outsized level of attention by the public and by the banking industry and really the entire world. I think there's a couple of reasons why that is. I mean, there's illicit activity that happens. It's anonymous. It has the term crypto, which is really exciting. But there are merits, I think, in elements of digital currencies that maybe can provided we can address a host of concerns. And so there are some things that need to be addressed before a digital asset, digital currency, even if it's backed by ultimately by fiat currency or by a central bank. And that is, I don't know that we can have an entirely anonymous medium of exchange, because there's 4.9 billion in estimated illicit activity, which is double the actual legitimate transactions in crypto. So certainly it is a medium. If it's anonymous, it'll be used for those purposes, which means we've got to figure out a way to monitor for BSA, ML, OFAC, et cetera. There has to be consumer protection. We've got to figure out the 20% loss rate estimated that money, it just goes missing because keys are lost, or there's outright theft. And then if one is concerned about the environment, there is a tremendous energy consumption that we haven't really talked about, just more broadly, that will continue to increase in calculating proof of work in order to power these. But I think there are benefits to fiat currency, or at least currencies regulated for prudential and consumer protection purposes. And it goes back to that reliability and stability concept, the underpinnings that I talked about and others did earlier. But those considerations, I think, can work behind the scenes. It's really that engagement layer that I think needs to get addressed. And if crypto is providing that, then hopefully this is just one step in a broader journey. So in spite of this, though, there are some elements of the inner workings of cryptocurrency that I think warrant ubiquity. And those are things like blockchain, that provides some permanency and smart contract capability, distributed ledger for resilience and veracity. And I think, though, if we step back and look at kind of the biggest lesson that I would say we should take away from the rise of cryptocurrency, is that if we, as the incumbency, whether it's on the fintech side or it's on the banking side, do not provide ready-made and efficient paths for others to innovate with ease, then I think innovators and the public both will demand a solution that works around, not with or through the banking system or the incumbents.
All commerce ends up in that dark alley. Right.
So separating out blockchain, and this is a question from the audience. Are you all seeing the implementation of real world applications of blockchain, and do you see that on the horizon?
Yeah, I absolutely do. And I think, the mistake is, kind of like the entire moon landing efforts of the effort of one gave rise to the technology that survived many things outside of the lunar programs that NASA launched back in the 60s. I think we're seeing the same thing with blockchain, and that it was created or utilized at first as a cryptocurrency or a transaction mechanism. But I think seeing blockchain and what it can offer from a data protection and privacy is way more interesting to me than it is from a cryptocurrency perspective. So the ability for a financial institution, or really any institution, to encode and then shard data across multiple data sources to make a hack or a breach of a database almost a non-existent function anymore. Because if I do hack into your database, I can't actually decode any of the data that's in there because it's sharded across 7 or 8 or 10 locations. To me is a very interesting advancement that I'm quite surprised hasn't taken on a bigger push from a GDPR or from a PII data protection perspective. There's a few companies out there that I'm familiar with that are starting to utilize blockchain as a non-transaction based technology, and I think they're gaining a lot of ground. So I think in the next 5 years, we'll see an advent of blockchain or blockchain type technologies that's around for more of data encryption and data encoding and data protection than it is as a transaction mechanism.
I think that's a great point. Yeah, I'd love to jump in a little bit about this, and I think it's important, right, to distinguish between the technology that is empowering the digital asset world, which is blockchain that we talked about, and how that can be not only in financial services, but kind of across the spectrum, how that technology is going to be developed and adopted. But would really love to kind of go back to some of Trey's points and the onset of the question about digital assets, and definitely agree with some of them, but also have a little bit of a different take on the use and the maturity of the industry as a whole. And so I think when we look at things like BSA, AML compliance, obviously the privacy, and so how some of these coins and alternative currencies are really pseudo-anonymous and not anonymous. And so, when you have the public ledger of the blockchain and you can see the transactions as they occur and the full history that is public, it does provide a level of transparency. And I think this also goes back to what we talked about earlier about banks' capabilities and, banks starting more and more to work with cryptocurrency and digital asset companies and what they're able to offer. So whether that's, access to the payments rails to help facilitate these transactions, or whether it's the compliance. So, from cross-reverse perspective, we're able to provide some of that BSA, AML oversight. And so when you look at a lot of crypto companies now and you see what it takes to open an account, it looks very similar to the information you have to provide to open a bank account. And that's, because the industry is trying to accommodate and provide for some of that security issue, some of the concerns around the potential of illicit activity, which, there's certainly different studies out there showing the level, but I think predominantly the use case, especially in modern time, is for legitimate transactions. And it's as the industry continues to mature, I think you'll see an adoption of companies being able and willing to accept it as a form of payment, which will help with the stabilization. I think the environmental concerns are certainly there that people are worrying about, and so you see certain blockchain and coins switching to a proof of stake instead of a proof of work, and different alternatives that are better for energy consumption. And I think it really, it's like any other innovation, it comes down to education. How are how well are you educating the regulators on the future of this, the capabilities, and being honest, because I don't think you could ignore that there is illicit activity, right? The same way in fintech, you can't ignore there are some bad actors. And so the level of transparency and education and engagement with the regulators, I think, will ultimately help determine the use, the maturity. The FDIC just released an RFI on how banks are using digital assets or working with companies that provide digital assets. And so I think it's right. These are the first steps in any innovation of getting an understanding of how it can be used. What are the potentials? What are the potential risks, and how do we mitigate those?
Yeah, Aaron, I just
Sorry, guys. In the interest of time, we're at our back end. It seems like it flew by, and it's amazing the depth this panel brings to the conversation. Jason, Bill, Aaron, and Trey, thank you so much for being. Really appreciate everybody in the communities taking the time out of their day to participate in this event.
thank you.
Thanks so much, everyone.
We're going to conclude our event.